Hi, I'm Tom Lydon, editor of ETF Trends here in Chicago at the Morningstar ETF Conference. And I'm here with Joel Dickson, who's principal of the Investment Strategy Group at Vanguard. Joel, thanks for being with us.
It's great to be here, Tom.
Let's talk about volatility in the marketplace, and specifically in August 24th, that day that the market was down 1,000 points, a little bit disruptive. There's some people that may not be in the know that are kind of pointing to ETFs as being part of the cause. What's your take on that?
Well, overall, market volatility has increased, but I think we got sort of too used to a low level of volatility by historical standards. And so, a move of a few percentage points in the S&P 500 on a given day wasn't unusual in, say, global financial crisis times or in the early 2000s. And now that we're seeing it again after a prolonged period of low volatility, I think people are sort of saying, wait, is the world ending as we know it? And of course it's not. Long-term buy and hold investing still works very well. Now, with respect to the 24th and ETFs, a lot of what we saw was this was really the first test of some of the new market structure rules that were put into place after the flash crash of 2010. And they worked as designed. The question is whether the design is exactly right for how, in increasingly electronic modern markets, ETFs work.
Yeah.
And that's where I think there's still some questions coming out of the 24th of what can we do so that the trading environment and the market structure really reflects the growth of ETFs as an important vehicle.
So certain securities were halted because they declined a certain period. And to that point, if you're trying to price an underlying index and a security isn't trading, something goes out of whack, correct?
Well, in the current environment, yes. But it's interesting because international ETFs, the underlyings don't trade when the U.S. market is open. Fixed income ETFs, a lot of the underlyings aren't trading. And yet those trade very well and did trade very well on the 24th of August. So it's more of the business model that has been built up where U.S. equity ETFs with the underlying securities became the way that people were sort of looking at it and hedging. I think that will change going forward. There was a lot of learning from the 24th that you can view these things as baskets, just like you do with international ETFs and fixed income ETFs. And I think we'll see that going forward.
And do you think the exchanges are probably going to have more uniform rules where we saw the NYSE put in halts where maybe over at bouts or the NASDAQ, they didn't have halts going on, right?
In the US, there are 13 different exchanges, right? And arguably or possibly 13 different sets of rules or procedures. Yeah. And that fragmentation led to a lot of what we saw on the 24th. So harmonization, reducing that fragmentation across securities or across exchanges, I think is a key piece of where we'll see things going forward.
Okay, let's give advisors and investors a couple quick rules.
Yep.
Specifically, in a day like that happens, and it looks like the world's coming apart. What should an advisor do? So
a couple of things. Yeah. And we've actually tried to educate, continue to educate a lot about how do you do ETF trading. And the first thing I would say is friends don't let friends use market orders. Okay. Market orders, if you are valuing speed of execution over price, when it comes to exchange-traded funds, that can be a very dangerous type of order. And in particular, stop orders, which become market orders once that stop price has been triggered. And in fact, what we saw on the 24th was this cascading of stop orders being realized and continuing potentially to push things down. So be careful, use limit orders. Don't put trades in over the weekend when you don't know what it's going to look like Monday morning on the open, when the volatility or the liquidity may be very different than what you're assuming.
So if your ETF closes at 12 on Friday and you say, I can't lose more than 10%, and you put a stop loss in at 11 and it opens up at 9, you're probably going to get 9 or less, just because that comes off as a market order.
Exactly, and that's regardless of whether the true value of the underlying securities of the ETF might still be at 11.
Yeah.
And you've got a market order in it, it may be trading at 9.
So is this a combination of we need to do a better job of educating advisors and investors on best practices in trading, but we're also looking to the markets to maybe continue to work together to provide a more ease in flowing systematic approach?
No doubt, and there's going to be a lot of look at the openings and reopening processes of securities, but at the same time, as you said, Tom, we need to augment that with continued education about, how does the T in ETF, the traded piece, really work, and how can advisors make sure that they get the most out of those investments?
Excellent. Joel, as always, thank you so much.
Thank you, Tom.